Welcome to the debate. Our focus today, well, it comes from looking again at Rich Dad, Poor Dad. It's undeniably a huge book in personal finance, and it gets a lot of credit, I think rightly, for sparking this really significant mindset shift for, millions of people.
Oh, absolutely. That credit isn't really in dispute. But the material we're looking at also frankly highlights the book's biggest issues, doesn't it? The acknowledged oversimplification of complex financial realities and, well, the pretty obvious lack of detailed how-to steps you need to actually do anything.
And that tension is exactly what we're digging into. The question is, does the book's real, lasting value lie almost entirely in that initial, powerful mindset change, that, psychological pivot? Or does that very inspirational style, precisely because it lacks a technical depth, end up limiting how effective it really is for achieving, let's say, genuine, sustainable financial independence? My position is that the behavioral shift it triggers is the absolute key contribution, really the essential first step for any successful financial path.
And I'm arguing that, while yes, inspiration is great, it's a catalyst. This particular framework, because it deliberately downplays the necessary technical stuff, the practical details, it gives you a foundation that's just, well, insufficient and potentially, honestly, a bit misleading when you actually run into the real complexities, the regulations, the hurdles of actually building wealth.
Okay, so when we look at why the book worked, why it resonated, we have to see that its core success is breaking down that behavioral barrier. That's often the highest wall to climb. Kiyosaki, he really does a job on the poor dad way of thinking, that, deep-seated belief about just trading your time for a paycheck and clinging to job security above everything. By completely reframing the goal to make money work for you, the book achieves something profound, pedagogically speaking. Its conversational style, the way it avoids dense financial jargon. That's not a weakness. I'd argue it's actually a brilliant strategic move. It makes it accessible to everyone, even people totally frozen by financial anxiety, letting them grasp core ideas like cash flow. That's the critical first step. Without getting your head straight first, all the textbooks in the world won't help because you're still psychologically stuck in that rat race.
That's a strong case from a behavioral finance angle, I'll grant you that. But I'm looking at this more from, let's say, a financial economic standpoint. The idea that just inspiration is enough as a first step. Well, it bumps up against the hard reality that actually doing finance is inherently technical. It's subject to rules, to fiduciary duty. So while the mindset shift is nice, it's functionally incomplete because the book chooses to leave out the rigor you need to apply it. The source material itself says the book won't teach you stock picking or real estate deals. Now think about who's reading this. Often people really struggling with debt. Just feeling inspired doesn't magically fix the mechanics of handling high-interest loans, or figuring out their actual net worth, or dealing with taxes. Real financial freedom demands specific, actionable knowledge. By minimizing the jargon, the specific academic know-how that governs investment risk and return, the book basically leaves the reader motivated, sure, but stranded somewhere between that motivation and the reality of the market.
Let's test that, though. Let's take maybe the simplest but also the most impactful concept in the book, that redefined difference between assets and liabilities. The way it's presented, asset puts money in your pocket. Liability takes money out. It's brilliant in its simplicity. It cuts right through all the confusing traditional accounting stuff and forces readers to look hard at their own consumption habits. It shifts their focus immediately away from things like car loans and credit card debt and toward things that actually generate income, businesses, stocks, rental properties. Now, this isn't just some abstract idea. This really simple, really clear lesson is the basic mechanism for escaping that cycle of debt. You can't really overstate how powerful this redefinition is for people traditionally just focused on, buying stuff.
I'm sorry, but while, conceptually it sounds neat, I just don't buy that it holds up under actual market conditions, especially when it's presented without any real technical backup. That definition, I think, dangerously oversimplifies the actual risks involved in putting your capital out there. You mentioned income-producing real estate. The book labels it an asset because, hey, it brings in cash. Simple. But what does the book tell you about due diligence? Nothing, really. So for someone who doesn't know better, that asset can turn into a cash-bleeding, debt-heavy liability really fast because of unexpected repairs or vacancies or not understanding things like debt service coverage ratios. The book gives you zero operational guidance how to calculate a cap rate, understand zoning, manage liquidity risk. It sets up this rosy picture with its simple definition, but provides none of the tools you actually need to navigate the frankly volatile and complex world of real asset valuation and upkeep.
But I think that's kind of misreading the book's aim. Its goal isn't to be your accountant or your real estate agent. It's to give you the mindset to even ask them the right questions in the first place. If you're still stuck thinking your house is your biggest asset, you're never going to even look for rental properties. The book successfully plants the motivation to seek out income generation. Then, and only then, does the technical stuff become relevant. You could almost say the framework is the technical lesson, just deliver through a lens focused on changing behavior first.
Right, but if the framework itself is the technical lesson, why is the advice that follows, like work to learn, not to earn, so incredibly vague? The book talks about getting skills, sales, marketing, understanding the law, which, okay, yes, are important for entrepreneurs. But someone trying to actually achieve financial independence, maybe while holding down a job, they need more than just general soft skills. They need specific, usable financial literacy about tax laws, about the regulations surrounding different investments, the actual mechanics of how you mitigate risk. That huge gap, the fact that it doesn't teach you how to read a balance sheet or understand depreciation, that's a critical failure for a book supposedly about financial freedom. Telling someone to learn investing without any practical method is, well, it just flaws flat.
That's an interesting point, though. I might frame it a bit differently. The skills Kiyosaki really emphasizes, sales, marketing, leadership, managing cash flow. These are arguably the bedrock, the long-term wealth creators that, frankly, traditional schooling often overlooks. We're talking about principles that hold true, regardless of what the economy's doing. Specific technical details like tax codes or the hottest stock strategy, they change constantly, year after year. The brilliance of the book, I think, is inspiring people to chase after those core entrepreneurial income-generating skills. It recognizes that the principles of creating value are timeless, while the specific technical stuff is temporary and something you have to actively go out and learn. It pushes back hard against that poor dad idea of just study hard, get a safe job, replacing it with this drive for constantly learning high-value skills.
Continuous learning is crucial, I agree. But we have to talk about the potential danger that mindset shift creates when it's not paired with technical skill. We're discussing a book aiming for financial independence. Independence demands a pretty high level of knowledge just to manage risk effectively.
And I'd say the highest risk is doing nothing, staying trapped in that wage earner loop. The book's biggest win is empowering people, especially those raised to value job security above all, to finally start questioning that supposed stability and actually explore investing capital. It gives them the confidence to push past those big psychological blocks, fear, and greed. Just getting someone inspired enough to take that first step, that's often the hardest part.
I'm just not fully convinced by that line of reasoning because it seems to ignore a big chunk of the potential audience. The people who are genuinely stuck in debt or maybe looking for a quick fix. You give them only this mindset shift, this big boost of confidence, while openly admitting the book won't teach you stock picking or real estate deals. It feels like you're inspiring them to take risks, potentially big ones, without the critical technical knowledge they need to handle the complexity. This approach, where confidence kind of trumps competence, well, it could lead directly to uninformed speculation, couldn't it?
Okay, but could you elaborate on how that uninformed confidence specifically turns into financial danger? Because, again, my point is the book's main job is to get people started reading annual reports, going to seminars, doing the research they were ignoring before.
Absolutely. The danger is how easily that newfound confidence can nudge someone into, say, dabbling in things that are easy to get into but super high risk. Think volatile day trading or poorly researched private deals they hear about, or maybe leveraging real estate way too aggressively without understanding how interest rate hikes or balloon payments could wipe them out. That simple asset liability definition, when you mix it with the strong urge to make money work for you, can easily lead someone to mistake a highly leveraged, poorly understood gamble for a solid foundational asset. So the behavioral change happens, yes, but without the tools for risk assessment, the person is actually quite likely to increase their financial stress because they lack the technical grounding to tell a good opportunity from a dangerous one. The inspiration starts the engine, sure, but the book doesn't give you brakes or a steering wheel.
But isn't that risk only really a problem if the reader just stops right there at the inspiration stage? I see the book's real contribution as forcing the reader to realize they need those brakes and steering wheel. It gives them the basic idea: you need to acquire assets. If they then fail to go get the technical know-how, well, that's on the reader, isn't it? Not the book's fault. The book does its job. It breaks down the psychological walls that stop people from even thinking about investing or starting a business. I mean, you could have all the technical knowledge available, but it's useless if the person is still philosophically chained to the safe job idea. The book successfully provides the motivation to go seek the technical education. It makes the paradigm shift happen.
That sounds a bit like shifting the blame for the book's lack of completeness onto the reader. Look, while the book is a fantastic initial motivator, I stand by this. For something aiming to chart the path to financial independence, leaving out practical instruction on loans, taxes, how to value things, how to manage regulatory risk, that's a pretty severe limitation. It means the transformation it offers is, really best case scenario, a temporary motivational boost. It requires a significant amount of outside learning and resources to turn it into a workable, sustainable path to actual freedom.
So, to wrap up my side, the book's defining achievement is its profound, and I think necessary, critique of how we traditionally think about money. It successfully sparks that initial, critical change in behavior towards actually building wealth simply by redefining assets and pushing readers relentlessly towards getting income streams instead of just relying on wages. That fundamental shift in psychology and behavior, that's the highest yield part of the whole thing.
And while I absolutely acknowledge that initial inspiration is valuable, it's clearly there and needed, the book's own admitted shortcomings on the practical, technical side mean it really only serves as a first conceptual step. To actually succeed in the complex, high-stakes world of capital markets, readers absolutely need to supplement it with detailed financial and legal knowledge. That's the only way to effectively translate that motivating mindset into sustainable, responsible financial action.
Yeah, this whole discussion really highlights a central tension in financial education, doesn't it? How effective is a purely behavioral approach versus the clear need for technical know-how? The material really shows that getting to financial independence probably requires balancing these broad, motivating ideas with very specific, actionable technical skills.
Indeed. And the question that still sort of hangs in the air is whether inspiring action, but without providing the technical ability to act safely, is ultimately a net positive or not. There's definitely more to explore here in how these big theoretical mindset shifts actually translate or fail to translate into profitable and, importantly, responsible financial moves in the real world.
Wait a moment. Since you are here, please consider subscribing and comment which book you want next. Take care, keep reading, keep shining.